Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 17th of August. Middle East tensions were rising this weekend as US-Iran ceasefire nears its end, yet the good news is that oil prices remain surprisingly steady this Monday morning as Gulf producers apparently find alternative ways to keep crude flowing. Global bond markets, on the other hand, look more nervous this morning with Japanese, Australian, and New Zealand yields jumping this Monday, but US yields remain steady on easing hawkish Fed bets, and that's helping sentiment sweet and focus on strong second quarter earnings into the European and US Open. So we will talk about what's driving the market sentiment today and what to watch throughout this new week of trading. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
Okay, so the weekend news from the Middle East wasn't ideal with the US and Iran ceasefire due to, and today, as soon as this Monday, Israel struck Lebanon. On the other hand, we have the news that the US is preparing now fresh sanctions on Iran to pressure the country to the negotiation table, while Iran, on its end, showcased a more offensive stance last week, remember, suggesting that the peace is not necessarily in sight for the near future. But that said, the energy market's reaction to the weekend news today is quite muted. Investors seem to react more to the news on the wire that Gulf nations have somehow found ways out of the Strait of Hormuz by going dark sometimes and ferrying oil through the Strait of Hormuz, then transferring oil to the oil tankers in the Gulf of Oman to sail the oil away to international customers. According to Bloomberg, Gulf producers actually channel more than 4 million barrels per day of crude out of the Persian Gulf in this way, keeping oil prices in check despite the deteriorating geopolitical situation and outlook in the Middle East. As such, both US and Brent crude trade flat this Monday morning near $82 per barrel level for the former and a touch below the $89 per barrel level for the latter for the Brent crude. But sovereign yields, on the other hand, tell a completely different story today. The US yields, for example, kicks off the week quite flat on the back of these hawkish Fed expectations are fading on soft inflation and jobs data from the US in the last weeks. But Asian yields gapped higher this Monday with the Japanese 10-year yield jumping past the 2.92% level. That's the highest level since 1996. We saw a comparable jump in Australian and New Zealand yields this morning, telling that the mood that we see in yields today was rather a global story than Japan-centric. As per Japan, while the rising hawkish Bank of Japan expectations due to the fact that the Japanese yen is losing ground so fast, but has so far failed to give support to the Japanese bonds and to the Japanese yen as well. So the dollar yen this morning is softer still due to a broad-based softness in the US dollar on the back of fading Fed rate hike bets, softened by the latest weakness in the US jobs, inflation, and retail sales data, as I said earlier. But overall, any fresh rally in oil prices could throw a floor under the US dollar's weakness, at least in the short run, temporarily, because the long-term outlook for both the US dollar and the US sovereign bonds looks bearish. Investors very much dislike the boiling Middle East war today that is costing to the US way more than it should have. This war was supposed to be a few weeks operation, remember, and now there are even news on the wire that US doesn't have enough ammunition left to fight a long war to tell how much this is costing to the US economy. And while the exploding US debt with no such thing as budget discipline from the Trump government, the trade frictions and the loss of appetite for the US generally is weighing on US debt appetite, as national debt of the US is about to surpass the 40 trillion US dollar mark. And that doesn't echo well among investors. The US 10-year auction last week settled at the highest yield since 2007, remember, as the 30-year bond auction was settled past 5.20% level, and that despite the softening hawkish expectations for the Federal Reserve and for the September rate hike bets. So there is a chance that the rising global yields will at some point, threaten the equity risk appetite. But that's not going to be the case today, apparently, because US and European futures are in the green at the time I'm talking here this morning into the European weekly opening bell. In fact, the second quarter earnings have been so strong on both sides of the Atlantic Ocean that investors are not willing to jump off the back of a bull, quite conscious that the underlying economic and geopolitical issues around the world have not necessarily been bad for company earnings. On the contrary, the higher and volatile energy prices have been a boon for global energy companies, especially for the European ones, while banks printed strong quarterly results due to increased activity both on trading and financing of the massive AI build-out around the globe. So overall, if oil prices remain in check, keeping the central bank hawks at bay today, I see little reason for investors to jump ship. This week, however, we will have a better idea on the possible K-shaped US growth, with big retailers in the US due to announce how they performed in the second quarter of this year, with, remember, rising energy prices that was pushing inflation and inflation expectations higher and waiting on consumer sentiment. Now, I expect to see soft results for many of these retailers and quite a strong quarter for those retailers who are proposing low prices to attract the consumers that have been hit by rising oil prices, like Walmart, for example. But the latter will probably not change the fact that the biggest earners of the S&P 500 earn big, and that despite potentially weakening consumer consumption and consumer sentiment and the consumer leg of the US economy altogether. On the contrary, results pointing at weaker domestic consumption in the US could further tame inflation worries for the US, and that would help easing the Fed hike bets even more, hence the positive pressure on the short end of the US yield curve. And that would be a positive development for the major US indices that are heavy in technology and that rely increasingly on debt sales to finance their massive AI build out, with their free cash flow levels for the big technology companies now falling to critical and even negative levels. We still continue to see that the fading hawkish Fed bets are being supportive of major US indices. Similar story for Europe. The underlying economies may be struggling with higher energy prices and rising inflation worries, but the Stoxx 600 index that actually makes more than half of its revenue outside the European continent, while printed a strong earnings season in the second quarter of this year, and earnings were also boosted by robust energy and bank earnings here as well. Now, the biggest risk for the European companies is obviously a renewed rise in energy prices, which would then push the European yields higher on hawkish European Central Bank bets. So oil prices will continue to matter for keeping the Stoxx 600 appetite in check near their all-time high levels. Any fresh push that we might see in the Brent crude above the $90 per barrel level could eventually spoil sentiment across the European stocks, and appetite would become increasingly sensitive to energy prices if Brent makes a fresh attempt toward the $100 per barrel psychological level. Interestingly, or not so much, there's one place where yields are pressured lower today despite the rising energy prices and not higher, and that's China. Chinese bond markets diverged notably from the Western and major Asian peers. The Chinese 10-year yield has actually fallen to the lowest level in a year on the back of the weakening consumer spending in China that keeps the Chinese economy near the cusp of deflation. The 10-year paper now yields around 1.68%. In 2004, it was near 5%. And the latter, along with the technology and AI support, is actually supportive of the Chinese stock prices. Like news this morning that Alibaba's open weight models accumulated more than 3 billion. Yes, 3 billion global downloads helps lift Alibaba's stock price in Hong Kong this Monday morning ahead of Thursday's earnings from the company. Zooming out, appetite for Hang Seng Index has peaked early August on worries that the Chinese AI companies are also facing headwinds due to their huge AI spending needed to keep up with the US rivals like OpenAI and Anthropic, while American AI champions, OpenAI and Anthropic especially, have been announcing fast-growing revenues on their ends into their upcoming IPOs. So the race is on, no one can afford to lose, and having a certain exposure to Chinese technology champions in this context could eventually be an interesting hedge against the impact of the Chinese competition on the Western technology peers and their broad AI circles, obviously. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.